Welcome to Fact Sheet 101. I'm Vern Cushenberry, Chief Investment Officer of 2 West, and today I'm going to take you through our fact sheet. We've spent the last 18 months designing the perfect fact sheet to support our retirement plan clients or institutional clients or wealth management clients, but we definitely had an eye in mind towards the responsibilities that we take on under ERISA, especially our duty to monitor. And we've created something here that's meant to be used in support of our investment policy statement and other materials that are all designed around our investment philosophy. So with that said, the prereq for this class is Investment Philosophy 101, where I talk extensively about what goes into that and what really drives our philosophy and decision-making process here at 2 West. But if I were to distill that down into just 30 seconds, that would be an evidence-based academic approach to investing in financial markets. And evidence to us means something that we can point to that has withstood the test of time and has been academically peer-reviewed and tested in a robust manner. So every mutual fund company, every investment company that we talk to has evidence of some kind, but we really look to set a higher standard with what we will adhere to in that investment philosophy. So for more details on that, please check that out. But I want to take you through this fact sheet today because it was designed to support our entire process, and at its core, it has 2 key pieces of differentiation vis-a-vis what you see most prominently in the rest of our industry. So there's a lot of scoring tools that are proffered by other advisory firms, Morningstar, FI360, RPAG, The Firm, MPT. There are our industry, their advisory business is inundated with ways to monitor funds. Where we've really taken it to a different perspective or the next level is by focusing a particularly keen awareness and focus on the fees. And here again, fees have been proven to be one of the most predictive data elements that you can look to and make use to influence your decision-making process across our entire industry. What we know about fees are that we can with certainty look to lower our fees and know exactly what we're going to get every time. And then the second key difference to this fact sheet is a long-term time horizon, and that's unique to the way that we look at the industry, or particularly consistent with our investment philosophy. Here we are heading into 2017. We're 7-8 years into a bull market, and many of the other systems that are available to investors, they look at 1 year, they look at 3 year, they look at 5-year returns. Maybe they go out to 7 to 10 years, but that's very rarely the most prominent time period. And we feel like, in accordance with the strongest academic evidence we can find, that a 7 to 10 year time horizon is crucial to assess the difference between a manager's skill and just blind luck, because we need a full economic cycle. We have to be able to assess a portfolio. We have to be able to assess a manager over a bear market and over a bull market, over an economic expansion and over an economic recession. And those typically run 7 to 10 years in length. That's why that's our primary focus and what we use to drive a good portion of our decision making. So with that said, I want to point out those 2 elements and then walk you through some of the other risk-reward measures on our fact page, so that when we're reviewing these in person, you have a frame of reference by which to view a lot of this data. So the fees which I mentioned are clearly featured at the bottom of our fact sheet here. You can see the net expense ratio for this fund, which is a dimensional small cap, is 0.37. That's very low, and when we compare that to the peer group, we know that's in the top 3% as ranked by fees. So that's terrific. We're right there. We have something that's consistent with our investment policy statement. We've actually gone so far as to codify this in our investment policy statement, as we have with a lot of the academic evidence that we look towards. The goal there being to take our investment policy statement and create a document that can withstand the test of time, because your investment committee is going to turn over. You're going to get new members on your investment committee, and by building an investment policy statement that clearly ties some of our decision making back to the strongest evidence that we can find, we hope to shore up that decision making on behalf of our sponsors for successive generations of committee members. So our preference there in the policy statement is for funds in the bottom or top 25, top quartile, 25% as ranked by fees. Okay, secondly, I mentioned the time horizon, and that's very prominent at the top of the fact page. Our graph here shows a 7 to 10 year time period. And again, that's a little bit unique. That sounds like such a minor thing, but what I know about investors is that what we, and the investing industry in general, is that what we choose to focus on has a huge influence on the ultimate outcomes that we generate in our portfolios. So let's take special care to direct our attentions towards those time periods that are most meaningful and have the most effect on the decisions that we'll make inside of the plan. So let's look at funds and a manager's track record over a meaningful period of time. We can see here that Dimensional has handily beaten their index, which is the Russell 2000, over this time period. And if we pan down the page here a little bit, we can get a little bit more granular. So from left to right, we have the most meaningful time period leading to, you know, a 10, a 7, a 5. You can see here as we move from left to right on the page, the time period moves from more meaningful to less meaningful data. There again, by design, we want to guide not just our own attentions, but all of our plan participant attentions, all of our committee members' attentions to the most meaningful data first, and then we want to review quarterly returns because it's part of our duty to monitor. As your fiduciary inside of the plan, we need to know what's going on with our funds quarter to quarter. But very rarely is 1 quarter's worth of data going to affect our decision making, because the world of investing just doesn't move that fast. We would have to see something very much out of line with the track record that a particular product had built over a 10-year time horizon to raise a serious red flag. Nevertheless, as you look at this data for Dimensional funds, what you'll see is that this product has outperformed its peers by 1.32% on an annualized basis for the past 10 years. That's outstanding. As you pan across the page there, you can see that the fund has outperformed its peer group in the 7, 10, 5, 3, 1, year-to-date, and quarterly. So we have a great product here. We also need to consider how well that fund's doing against its benchmark. That's what we're hiring this fund company to do. We are paying 37 basis points, which is more than what we would pay if we just invested in the underlying index. So we're paying extra to try to get something in exchange for that. And over a reasonable period of time, we should be able to expect that. Dimensional funds has similarly delivered on that promise as we compare their returns to the benchmark returns. What we see here is that this product has outpaced the bench by 1.13% on an annualized basis for the past 10. That's terrific. That holds for the 7, 5, 3 year periods. It did not hold this year, which is something that we will take notice of, but what we know is that all funds have a little bit of volatility, and that's to be expected. We can put that in further context with this next box here, where we'll look at return relative to risk. Every once in a while I'll get a request from one of our clients. They'll want to see all the funds in their lineup, and they'll want to see the returns associated with those funds. And I very politely try to dissuade them from that notion, because risk and return are inextricably linked. We have to look at them together. They are two sides of the same coin, and if we look at one without the context of the other, we put ourselves in jeopardy of making detrimental decisions to the plan. So let's look at them together right here on this fact page. We can look at standard deviation, which is a measure of risk. It measures volatility. The higher the standard deviation, the bumpier the ride. What we would all like in investing is a smooth ride. We would love to know with certainty that next year and the year after that and the year after that, we're going to earn 9% on our money with consistency throughout the lifespan of our investing period. That doesn't happen. Remember, risk and reward. Standard deviation measures risk. We can see here that the DFA product is taking on a level of risk measured by standard deviation, 17.24. We have to compare that to the benchmark and the peer group. So we are on par with the level of risk that we would be assuming if we just invested in the benchmark. You can see the bench at 17.41 here. Compare that to our peers at 15. Now there's some insight right there as we look at the fact sheet. What we recognized from the returns up top is that dimensional funds have beaten its peers in every time period. Well, they've taken on more risk. Okay, so we should expect them to outperform in a bull market when they're taking on more risk. That tells us a little bit, something about what we're getting in exchange for what we're paying. Let's break that down in further detail. I want to go down here to the Sharpe ratio. The Sharpe ratio takes a look at excess return. So now we're looking at how much return are we getting for that risk that we take on. And excess return is defined as returns in excess of the U.S. government T-bill. So think of that as the return that we could get if we took on no risk. Right now that's about 0.5%. So we take a look at the excess return and we adjust that by the standard deviation. Remember, standard deviation is risk, so we'll divide our excess return by how much risk that we take on, and that gives us a risk-adjusted return measure of 0.83 for dimensional funds here. Compare that to the benchmark. We're getting more return for the level of risk that we're taking on, so that's good. The higher the better with the Sharpe ratio. And we're also outperforming our peer group. So check, check. Dimensional funds continues to score well. The Sortino ratio is one of my favorites. You might have recognized that when I mentioned standard deviation, I mentioned the smoothness of the ride. Well, as a risk measure, when the fund goes up and when the fund goes down, standard deviation as a measure of risk is indifferent between those two things. But as an investor, what I really care about is when the fund goes down. The Sortino ratio adjusts for that and uses a risk measure in the denominator that only takes into account downside deviations in a fund's track record. That's a little bit technical, I know, but it gives us just another way of parsing out the data, and what you can see here too is that the excess return per unit of risk as defined by downside risk specifically for dimensional funds, 1.32 versus 1.27 for the peers and 1.16 for the benchmark. Higher the better. Good on Sortino ratio, good on Sharpe ratio. Let's move on down and now analyze risk-return metrics relative to the peer group. And we have another set here which are designed specifically for just that comparison. I want to begin with beta. Beta is one of the most common statistics in all of finance. It tells us how consistently a mutual fund varies with the underlying index. So, for example, if a mutual fund has a beta of 1.25 and the index is up by 10%, you can expect the return of the mutual fund to be up by 1.25 times the return of the underlying index. So if the index is up 10, then the mutual fund should be up 12.5. Works the same way on the downside. If the mutual fund is down 10, then if the benchmark is down 10, then the mutual fund would be down 12.5. So it's a measure of risk relative to the benchmark. The benchmark will always be 1. You can see here that Dimensional's fund is at 0.98, so approximately the same amount of risk as the benchmark. Look at the peers here again at 0.83. So the same story. We're using a different measure of risk, but it tells the same story as the measure of risk that we used in the table up top, standard deviation. Okay, let's talk about alpha. Alpha is a measure of return relative to the expected return as predicted by beta. So beta tells us how risky we are relative to the benchmark. If we have a 1.25 beta, I went through that little example there where the bench was up 10, our expected return would be 12.5. If our actual return were 13.5, then our alpha would be 1. So the alpha is relative to the expected return predicted by beta. So we want our managers to generate positive alpha. And the higher the better. The more alpha they deliver, the better job they're doing for us, because they're delivering a return for their stock picking ability, more so than just taking on market risk. So Dimensional Fund, here again, scores very, very well, 1.33 over the last 7 years versus peers at 1.02. So handily outpacing its peer group. Okay, now let me move down to information ratio, because we're going to take that alpha number that we just generated, and we're going to adjust it by tracking it. Okay, new terms, I recognize this, but keep in mind that alpha can be generated in a single quarter. If a portfolio manager takes a huge bet on China Faith Tech Wireless, some small cap, international, emerging market company, and they hit a huge home run, well, that's going to manifest in upside returns that are dramatic relative to the benchmark and positive alpha on account. Well, we may or may not want that. One big win, one great decision is not a hallmark of a portfolio manager that can deliver with consistency over time. Best case scenario, our portfolio manager is going to be able to duplicate those returns time and time and time again, because these decisions are being made with a mind towards the future. Information ratio tells us a little bit about that consistency. It takes that alpha and divides it by the consistency over time. And the metric that you're looking for here, the over-under on information ratio is about 0.5. You get to 0.5, a manager's doing pretty good. Dimensional Funds is at 0.54. They're adding a lot of alpha, and they're doing it with consistency. Compare that to the peer group here over the last 7 years at negative 0.16. The peers have really, really struggled in this asset class. Okay, two more metrics in this bottom table, R-squared and tracking error. Both of these measure style drift. One of the things that we need to adhere to, especially in the world of ERISA, is the style box approach. We need to provide a diversified lineup to our plan participants, and to do that, we populate 9 equity style boxes, an additional 3 fixed income, and an additional 3 international equity style boxes. Well, when we hire a manager to be our small cap manager, we need to make sure that they're adhering to that mandate. And one of the ways that we confirm that adherence is by monitoring over time R-squared and tracking error. R-squared, if the R-squared is 1, then a manager is generating 100% of the returns to that product from holdings inside of the index. So that's just a measure of a manager doing what he or she is being paid to do. If this number deviates too much below 90 or too much below 110, we might take a look at where those returns are coming from and whether or not we have a style drift problem. You can see the peers at 92. Tracking error, again, a measure of consistency, how consistently a manager is tracking the underlying index. A tracking error of 1 would be consistent with the index. 210 for dimensional funds versus 4.95 for the peer groups. So all in all, this product is tracking the index closely. We have no risk of style drift. They're generating positive returns. They're generating positive returns in excess of the amount of risk that they have to take on to do that. And they're doing it all in a manner that allows them to stand out, both relative to the peer group and the underlying benchmark. So we have a very, very solid product here. I'll walk you through the rest of the fact sheet here, mostly biographical data on the fund, with the one exception of this last box on the page here, which includes qualitative commentary from our investment committee. The fact sheet generally represents our quantitative data, and that's 50% or less of the total process. Here again, one of the main reasons for doing this was to come up with a dynamic process, because every market environment is different. We have to build something with the flexibility to include the little nuances that we inevitably stumble into. And this fact sheet represents only a partial view into the whole process that the Key West Investment Committee goes through to make ourselves comfortable with a mutual fund. And some of that commentary will always appear here at the bottom of the page. You scroll up to the top here. I have ticker symbol, benchmark, a little bit about the investment strategy. We will always have the date that the manager took the helm. Depending on the fund, depending on the fund management company, if it's a very actively managed company, and we see a date here like for Mr. Fogel, February 28th, 2012, he took the helm. So we go over here to the chart, and we have 2012. If this is a very actively managed fund, and we have a portfolio manager changeover, we could quite literally be looking at two different strategies, almost two different funds altogether. So we have to be very, very aware that this track record, if put together by multiple fund managers, might not at all be consistent of what we can expect in the future. So that's our job as an investment committee, to be monitoring that very, very closely, and we always put the date there to make sure that we and our investment committees ask questions when necessary. The appropriate style box is always listed on the fact sheet with asset allocation. So here again, we would expect to see this product in U.S. equities. Check. They're delivering on what we would expect there. Top 10 holdings. So very diversified. They don't have any holdings in excess of 2%. The largest is a cash, a government money market holding there with some S&P E-mini futures to add liquidity to the product. And then additional information at the bottom of the fact sheet. So inception date, fund assets, 12-month yield. I already talked a little bit about expense ratio. Again, please watch that investment philosophy webinar for a lot more information on just how important expense ratios are. And then fund to benchmark. So please let me know if you have any questions. I look forward to rolling this out on a in person, in meetings, and then on a quarterly basis. I hope to get the highlights of any major fund changes to our what we consider to be our gold standard lineup. So look for that, and thanks again for your time.